So in this video, we will be seeing about the systematic analysis of a company. To begin with, any analysis, so we must do it hierarchically as follows. We must do first of all industry analysis, then we must do company analysis, and after company analysis, we must do financial analysis. So let's take industry analysis. What is this industry analysis? Company producing the similar products form a subset of an industry or a sector. For example, if we take NHPC, National Hydroelectric Power Company Limited, or NTPC Limited, or Tata Power Limited, all these companies produce power and they belong to power sector. So it is very important to see how the industry to which the company belongs is performing. Important parameters like effect of the government policy, future demand of the products need to be checked in the industry analysis. At times, even the prospects of the industry may change drastically in a business environment. For instance, devaluation of rupee may brighten the prospects of the export-based companies, and this is what we must do in the industry analysis. And then once we find that industry analysis is very good, now let's narrow down to a company in that industry, and that's what we do in the company analysis. What we do in the company analysis, how this particular company has been doing in the past years. Let's say like we are taking Tata Power company. So how this Tata Power company is performing in the past few years. Also, we must seek information on their current operations. How about their management? What are all the future growth plans, if any, it is having, and how it is better when compared to its competitors NTPC and HPC. So these things we will do in the case of company analysis. Once we are done the company analysis for each of these company, uh, then we will focus on the financial analysis. So what we will do here is we will check the current price of the share, and we will try to check whether it is going to be a good buy or not. For this, what we need to do is we need to do the financial performance of the company. We need to actually analyze the financial analysis performance of the company. So we need to check like few parameters like earnings per share, how it is, P bar E ratio, and also the current size of the equity, the number of outstanding shares. All those things we must analyze. So to understand these things, fundamentally we must do the analysis of their balance sheet as well as the profit and loss. So these two are actually found in the annual report of the company. So what is this annual report? So the annual report is usually a formal financial statement issued yearly by the corporate. The annual report shows the um, assets, liabilities, revenues, expenses, earnings, and how the company stood at the uh, close of the business year. Those things will be found, and the other information which is of interest to the shareholders, like how it had profit-wise during the last financial year. All those things will be deliberately discussed in the annual reports. So companies publish this annual reports, and they send it to the investors free of cost. So before investing, the investors' responsibility is to go through these annual reports, understand their financial standings, and then they must invest. If you want a detailed annual report is also can also be sent on request. Remember, an annual report of the company is the best source of information about the financial health of the company. So what are all the features that one must check in the annual report carefully? First, I would say the director's report. It's a very important thing. So director's report one must see, which are related to the current and the future operational performance of a company. And then one must also check the auditor's report and the P&L, balance sheet, and then the if any there is any notes for the P&L or for the balance sheet, then these things also must be checked during the analysis of the annual report. So what is a balance sheet and a profit and loss statement? And also what is the difference between the balance sheet and the profit and loss statement? So if we take balance sheet, it actually shows the financial position of the company at a particular point in time. Maybe when the maybe it may be as of okay 31st March, maybe 2015 for the FI okay 2014 to 15 report. So it will be for a particular point only. Whereas P&L is for the entire okay financial year. It's for a period, for a given period. This is a point, whereas this is for a range of period. Usually for the entire okay FY14 to FY15. That's one of the main difference between the balance sheet and the profit and loss. So this is the balance sheet of the company called some XYZ. So here we are going to analyze different constituents of the balance sheet. So the balance sheet has two important okay components: sources of funds and then the application of funds. So what does the sources of funds represent? Actually, there are two sources of funds in this case. One is the shareholders funds, which is the fund coming from the owners of the company. This is the owner's capital. And loan fund are the funds that is coming from the outsiders, not from the owners. And this shareholders fund is also called net worth. They also call it as net worth. So when a company starts operation, its owners called shareholders contribute funds called share capital. Okay, so this is that share capital. And as of March 31st March 2005, the share capital is 103 crores for this XYZ company, and the shareholders being the owners, the share part of the profit of the company is called as dividend. So share capital has been can be further divided into two things, that is equity capital, other one is the preference capital. There are two parts in this, equity and preference capital. So however, equity capital does not have any fixed rate of dividend, but preference has the fixed rate of dividend. So after distributing the dividends, okay, a part of the um, profit is retained by the company for meeting future requirements in the days to come. So the retained profits accumulated over the year is called the reserves and surplus. Now the retained profit for this XYZ company as of 31st March was 479 crores, and obviously the okay reserves and surplus has increased from 387 to 479 crore in 2005. So now that I said about the equity shareholders and the preference shareholders, what is the difference between them? So this equity shareholders, they are supposed to be the owners of the company, and therefore they have the right to get dividend as declared, and also they have the right to vote. These people have right to vote, but the preference share, they also enjoys preferential right as to payment of dividend at a fixed rate. But however, these people do not has that voting power. This is one of the fundamental difference between them. So one more thing at this point I want to discuss here is the the types of capital. We have something called authorized capital. What is this authorized capital? Authorized capital is the maximum capital that a company is entitled to raise or authorized to raise, and this is fixed by SEBI, Securities and Exchange Board of India. And then we have something called issued capital. This issued capital is a part of the authorized capital. So it's like this. So we have a bigger circle, okay, which is the authorized capital, and then we have another bigger circle, which is called the issued capital. Okay, uh, issued capital is that part of the authorized capital which is offered by the company for being subscribed by the members of the public or anybody. That is the issued capital. And then inside the issue capital, as I said, there is one more circle called subscribed capital. Subscribed capital is that part of the issued capital which is subscribed by the public. Okay, so whatever that is outside this circle, inside this I, will be maybe private. So this is public. So in this subscribed capital, we can put one more circle. I don't have any space, so let me put this separately. So one more circle. This is called up capital, and those outside the circle are actually paid up capital. So this is paid up capital, and this is called up capital. What is called up capital? So called up capital is a part of subscribed capital which has been called up by the company for payment. Usually, when the company is issuing shares, public will come and subscribe for it. But not everyone will pay money completely and subscribe. Some of them will pay part of the money and then subscribe it. The remaining part will be paid by them in the future. A few of them will pay it completely, and so they don't have any obligation to the company. So the people who paid completely and their portion of capital is called paid up capital. Whereas the people who pay part and they will be paying the remaining amount of money in the future, that is called up capital. So what happens is, in the called up capital, let's say the company has 10,000 shares. Okay, in the 10,000 shares, let's say each of rupees 100, of which 50 rupees has been paid by all these 10,000 people, then the company and the subscribed part of the company works out to be one uh, 1 lakh, not, yeah, correct, it's 1 lakh, of which the called up capital forms 5 lakh, and the paid up capital forms the remaining 5 lakh, which means, okay, 5 lakh is the amount that has been completely realized from the shareholders. The remaining 5 lakh is yet to be realized, and that's why the company call up the subscribers to pay the remaining amount of money. Now let's see what is the difference between the secured loans and the unsecured loans. The secured loans are the borrowings against the security. That is like we will be giving some mortgages here, or sometimes we may even give um, some hypothecates or pledges, wherein some mobile property of the company is being given. So in case the counterparty defaults, the company will attach liquidate whatever they have given as a security to compensate for the loss. So in the case of this XYZ company, it is 353.34 crores as of 31st March 2005. Whereas the unsecured loans, these are mostly short-term borrowings without a specific security. It could be like fixed deposits, or it could be even loans and advances from the banks. The company is having as of 31st March 129.89 crores. So let's see the application of funds. So what is application of funds? The funds collected by a company from the owners as well as from the outsiders are usually used to create, okay, are usually applied to create the following assets. This is called application. Using the money that is raised above is called application of funds. So what, how these funds will be applied? It can be used to procure fixed assets. It can be used for investments. It can be used for current assets and loans and advances. And also there will be other miscellaneous expenditures. So let's see each. What is fixed asset? These are the assets that are acquired for long term mostly, and are used for business operations. It is not meant for resale. No resale of this will be done. And the land, buildings, plant, machinery, patents, copyrights, these are the fixed assets of a company. So if you take this company, it is 946.84 crores as of March 2005. What are investments then? Investments, these are the financial securities created by investing surplus funds into non-business related avenues for getting income. Like we do, okay, invest in stock shares, right? Similar to the company XYZ also as invested in stocks and shares. And they have got around 108.58 crores as of 31st March 2005 from investments revenue. But so we must also make sure that the investments are not actually forms part of the business operation. They are non-business operation. And then we have current assets, loans, and advances. Actually, this consists of cash like this, inventories, which can be converted into cash during the business operation. Like these things can be converted into cash during business operations, right? So these are the current assets. Current assets are usually held for a short-term period for meeting day-to-day operational expenditures. So current assets will be in the form of raw materials, finished goods, cash, debtors, inventories, loans and advances, and prepaid expenses. For the XYZ company, it is around 1165.20 crore as of March 2005. And then we have other miscellaneous expenditures and losses. This miscellaneous expenditures and losses usually represents certain outlays such as preliminary expenses and pre-operative expenses not written off. Though lost, though loss indicates a decrease in the owner's equity, the share capital cannot be reduced with loss. Instead, share capital and the losses are shown separately on the liability side and the asset side of the balance sheet respectively. So if you see here under the fixed assets, we have some sub sections. So what does this gross block, depreciation, net block, capital work in progress mean? The total value of acquiring all the fixed assets, okay, except land. Okay, everything will have a fixed life. All the fixed assets except land has a fixed life. And it is assumed that every year this fixed assets worth will fall due to continuous usage. This reduction in the value is called depreciation. As far as the Companies Act 1956 is concerned, it has actually mentioned for each fixed asset a certain rate of depreciation, and also it has even told the way to calculate the depreciation for different types of assets, namely like straight line method or written down value method. So using these methods, the depreciation will be calculated, and then this depreciation will be reduced from the fixed asset value, and then we will arrive at the net block. So as far as the company XYZ is concerned, it is 464.65 crore as of March 2005. The capitals and the funds used for a new plant under erection or a mission yet to be commissioned, those are the examples of capital work in progress, even though they form a part of fixed asset. Okay, uh, but however they are not cross flag as of now. So, but however it will be included under the fixed assets section since it belongs to fixed assets. Since it is going to be a fixed asset soon. And then we have something called current liabilities and provisions. And also, if you could see here, we have something called net current assets. What are these things? If you take a company may receive many of its daily services for which it doesn't have to pay, immediately. Like for let's say raw material, it will get from the suppliers on a credit basis. And also, the company may also accept advances from the customers on a credit basis, and later they will give the goods and services. Thus, if you see here, the company has a liability to pay, though the payment is deferred. These are known as current liabilities. Okay, and what are provisions? So similarly, the company has to okay pay, or it has to pay for certain other expenses like dividend to shareholders, tax. Those also has to be paid, but it may not be paid immediately. Okay, in short, these are called provisions. So current liabilities and provisions are the amount due to the suppliers, or maybe to the taxman, maybe to the customers. Uh, Maybe these are like accrued expenses, like maybe gratuity or maybe pensions, etc. So they are actually due. That's one thing we must take away from this section. As of March 2005, our XYZ company has around 734 crore in the form of current liabilities and provisions. So what is this net current assets? Current liabilities and provisions, as we saw that it will reduce the burden of day-to-day expenditure on current assets by deferring some of the payments. For daily operations of the company requires funds equal to the current assets less current liabilities. Okay, so we already know what are the current assets. This is a current asset. So what happens is whatever amount we owe, whatever expenditure we owe, if we subtract from this, the remaining surplus that is left, that surplus is this amount. And this is the net working capital of the company, NWC. Because for daily operations, the company requires some funds, and that fund is this fund. So as far as this XYZ company is concerned, they have around 430.98 crores on March 2005. So how is this balance sheet summarized? Balance sheets indicates matching of sources of fund with application of fund. So if you see here, the total of application of fund is 1066 crore, and if you see the total of source of fund, it is also 1066 crore. These two should match. So in short, we can say that total capital employed should be equal to net working capital, that is the net assets. So that's it as far as the balance sheet is concerned. Now let's see about the profit and loss. So this is the balance. So far we have seen about the balance sheet of the XYZ company. So this is a P&L statement. So profit and loss account shows how much profit or loss has been incurred by a company from its income after providing for all the expenditure um, within a financial year. One may also know, as you can see here, this is the income that it has got through revenue, and these are the various costs that is incurred in making this particular revenue. So ultimately, if you say this as a selling price and these are the cost price, selling price minus cost price will give you the profit, right? That's it, as simple as that. So in this, if you see, um, okay, so one may also know how the profit is available for appropriation by using profit after tax as well as the portion of the reserves. So if you could see here, this is a tax amount that is being paid. The tax will be on the PBT, and so this is a profit after the tax, and we have a lot of allowances like investment allowances, and then the debentures redemption reserve, capital redemption reserve, and then the balance brought from the previous year. All these things are there. These things will be added here, and then we will arrive at a amount which is available for appropriation. So what are the appropriations that we have? Usually the amount that we arrived at can be used for giving dividends, and part of them will be kept as a uh, reserve to meet any unforeseeable loss, maybe due to natural calamities, all those things. So for that they have reserved around 100, and the remaining balance will be reinvested in the company's operations. So this is how the amount available for appropriation, which is the amount that is left after paying tax, after paying the cost price, and after getting the incomes and balances from the previous year. So this amount will be spent for these three purposes. So now that we have seen about this P&L statement, so let's see like what are all the important things that one could look for in a P&L account. So important things one could see in a P&L account. Let's see that. So for a company, the profit and loss statement is the most important document presented to the shareholders. Therefore, every company tries to give maximum stress on the representation as well as the misrepresentation of this P&L. So one should be very carefully peruse this P&L statement. So whether important thing that one must notice the overall improvement of sales as well as the profit. This is something one must see particularly. This is a fundamental thing that everyone should check. So if you could see the profit, it can be operating profit, or it can be gross profit, or even it can be the net profit. So these three things one must see in the P&L. Second thing is one must also check the other incomes which the company has mentioned in the P&L very carefully. So here, this other, because there are a lot of scopes here to manipulate the other income. Other income, if it is coming from, let's say, like dividend, because dividend in the sense like the company would have invested somewhere, like us. Okay, we are investing in stocks, so they would have invested somewhere as institutional investors, and they would be getting some dividends based on the investments they have made. Sometimes they would have given loans also, so they will be getting some interest income based on the loans and advances they have given. So if it is that type of other income, so this type of other income, then it is good. Okay, because why it is good? Reason is these will be consistent. Every year there is a good amount of chance that we will be getting this other income consistently. But if the other income is derived by selling any assets, okay, or land, these things are like once in a while occurrence, right? Once in a blue moon occurrence. So this is not something, okay, a good indicator. It's a bad indicator. So one must not, uh, you know, go into a fallacy that a company is having good amount of income without understanding the nature of the income. And next thing is we must also check for the increase of the expenditures, like which expenditure is getting increased. This for this we must do some trend analysis. Let's take, okay, 5 years, and then okay we must check uh, uh, okay which expenditure is eating up the income, that we must check. Maybe it can be a raw material consumption or manpower cost or administration or selling expense. So if these costs are more than the increase of the expenditures is more than the increase in the sales, then it reveals that the operating conditions of a company is not good. Okay, for this you must see, let's say, like a 5 years trend. If the increase in sales is not as okay fast as the increase in expenditure, then the operating conditions of the good or the management of the company is bad, in a bad shape. And also you must scrutinize the depreciation. Depreciation. If you see the depreciation is getting increased, it would eat up the, okay, profit, right? So obviously we will be left with the less profit after tax. So this would as falsify, our opinion about the company. The reason is, even though depreciation has increased, if the increase in the depreciation is because of the higher addition of the fixed assets, okay, which are actually going to be the income generators for the company in the future or in the long-term operations of the company. So that is that is causing, okay, less PAT. That doesn't mean that the company is not performing well. The company is indeed performing well. So one must look at the cash flow here, because the dividends will be added in the cash flow statements, right? So one must check the cash flow in this case. And another thing is, instead of looking out for the net profit, so you must check the cash profits and compare whether it has risen. Uh, Higher interest cost is also a cause of concern, because the increased debt burden cannot be reduced in the short run. So you must also check the interest expense. The interest expense is so much and it is eating a lot of, okay, profit, then okay, then that says like the company is not, you know good in the debt management. And also one can calculate the EPS, right, earnings per share, and other various ratios. um, so this also, okay, some of the indicators that one must check in the P&L statements. So one can also do, okay, a lot of ratio analysis based on the P&L and the balance sheet. So what are all the, basically, right, we will do three types of ratios analysis. One is called liquidity ratios, Another one is the leverage ratios, and the third one is the profitability ratios. So let's see this, okay, one by one. So what is liquidity ratio? So liquidity ratio usually refers to the ability of a firm to meet its financial obligations in the short term, which is less than a year. Certain ratios which indicate the liquidity of the firm are the current ratio, acid test ratio, turnover ratio. So let's see about the current ratio. So what is this current ratio? Current ratio is given by current assets upon current liabilities. So these two things can be got from the balance sheet itself. So the current ratio measures the ability of the firm to meet its current liabilities from the current assets. Higher the current ratio, greater the short-term solvency. And next is the acid test ratio. Acid test ratio can be got by, okay, quick assets. Quick assets mostly includes uh, all the current assets excluding inventories. It includes even the prepaid expenses. So upon the current liabilities, generally speaking, okay, 1:1 ratio is considered to be satisfactory. So it's a measurement of actually the firm's ability to convert the current assets into cash in order to meet its current liabilities. And now we will see about few turnover ratios. So what are these turnover ratios? So turnover ratios usually measure the quickness of how quickly a company can uh, get its current assets converted into cash, or you can say like how efficiently the assets are being used by the company. These are the, okay, metrics that we can measure in the turnover ratio. So first one we will see is the inventory turnover ratio. So inventory turnover ratio is given by the cost of goods sold upon the average inventory. So here the cost of goods sold means the sales minus the gross profit. That is the cost of goods sold. And the average inventory is like take the opening inventory of the current year and the closing inventory of the last year, and then take average. The inventory turnover ratio, what it tells actually, it tells the effectiveness of the efficiency of the inventory management in a company. Higher the ratio, more effectively the company is managing its um, inventory. Next we have something called, so higher the number, better it is quickly getting its, okay, inventory uh, to get converted into cash. So the inventory is getting converted into cash in a faster way. So higher the ratio, better the, okay, company is in terms of inventory management. And then we have something called debtors turnover ratio. So this is given by net credit sales upon the average accounts receivables. So here what is happening is the ratio shows how many account receivable debtors turnover during the year. If the figure of net credit sales is not available, then one can take the entire sales figure in the numerator. So higher the ratio, okay, higher the ratio, better the efficiency of credit management. And then we have fixed assets turnover ratio. So fixed assets turnover ratio measures the sales per rupee of investment in a fixed asset. So this is like net sales upon net fixed assets. So in other words, it measures how efficiently the fixed assets are employed. So how every $1 of fixed asset is giving, how much one every dollar of fixed asset is bringing in sales. Now let's see about the second part, which is the leverage ratios. This is also called capital structure ratios. Long-term financial strength or the soundness of a firm is measured in terms of its ability to pay the interest regularly or repay the principal on due dates or at the time of maturity. So, such long-term solvency of a firm can be judged by using this leverage ratios. So, leverage ratio basically measures the long-term solvency. That is one thing you must understand. Here, there are two sets of ratios. First, the ratios are based on the relationship between the borrowed funds and the owner's capital, which are computed from the balance sheet. Some ratios are like, of such type are the debt to equity ratio and debt to assets ratio. These are those ratios. And the second set of ratios are actually calculated from the P&L account. They are like, interest coverage ratio and also debt service coverage ratio. All those this kind of ratio will cover you. So let's see each of this ratio how it is calculated. First, let's see about the debt to equity ratio. So debt to equity ratio is given by the formula total debt upon total equity. So it actually reflects the relative contribution of creditors and owners to finance the business. So the desirable or the ideal proportion of the two components varies from industry to industry. So you can't make any judgments unless and until we are actually okay, sure of the industry we are talking about. So debt asset ratio. So debt asset ratio. This is debt to equity, and the next one is debt to asset ratio. Very simple. Again, total debt will be there, but here the total assets will be there in the denominator. So here the total debt comprises both long-term as well as the current liabilities. The total asset comprises the permanent capital plus the current liabilities. Now let's see about the interest coverage ratio. Interest coverage ratio is like EBIT, earnings before interest and taxes upon the interest. So higher the interest coverage ratio, better the company's ability to meet the interest burden. The lenders use this ratio to assess the debt service capacity of a firm. And another ratio with the lenders will see is the debt service coverage ratio. It's a more comprehensive and a very apt one to measure the debt service capacity of a firm. So financial institutions usually calculate the average debt service coverage ratio for the period during which a long-term loan of a project is repayable. So how this debt service ratio is measured? So just put the PAT, with the PAT add depreciation, along with the depreciation even add other non-cash expenditure plus interest on term loans. So all these things has to be added and it has to be kept in the numerator. In the denominator we have to put the interest on the term loan again, because usually we are seeing this is the interest that the company is going to pay. We are trying to match the interest with the profit capacity of the firm. More the profit, better they are able to pay, right? That's the way. Let's say like I'm having 5 rupees interest and my profit is 10 rupees, then I am capable of paying two debts which is actually having 5 rupees as the interest. That is the um, theme or the bottom line of these ratios. So interest and then the repayment of the term loans. These are the debt service ratios. Now let's see about the profitability ratios. What are all the profitability ratios that we have? We have something called gross profit ratio. So here the operating or the management efficiency of a firm is being computed. So just put gross profit in the numerator and then the net sales and then express in terms of percentage. Similarly, we have net profit ratio. Just put the net profit. These are like very simple. Okay, net profit upon net sale in turn. And also we have return on assets, which is PBIT upon fixed assets plus current assets, which is the total assets. And also the return on capital employed, ROCE ratio. This is actually calculated by again uh, net profit, that is the numerator, and then the total capital employed. So what is this total capital employed? Total capital employed usually denotes the, if you could see, remember our balance sheet, okay, explanation. It denotes the total fixed assets, okay, and then the current assets, that is the net assets, okay, subtracted by the current liabilities. It is usually the working capital, net working capital. That is the return on the capital employed. And also we have return on equity under the profitability ratios, which is given by again the PAT or the net profit upon the shareholders equity, or we can say average shareholders equity, or we can say this as even the net worth. I already explained in the balance sheet what is the net worth. Apart from that, one can also calculate the EPS based on the, okay, even though these are available ready-made in the market in different websites, all these ratios, one can also calculate on our own. This is done like this. So what is the PAT that is available to the shareholder? The PAT available for appropriation. Then upon this, you must divide it by number of outstanding shares, number of ordinary shares that is outstanding. And we have even something called P bar E ratio. This is very simply calculated. Put the market price of the share in the numerator and then put the earnings per share, which you have calculated here in the denominator. This says like for every $1 or maybe 1 rupee that I'm going to earn upon buying that share, I am ready to pay a market price of, let's say if it is 2 rupees. I'm ready to pay 2 rupees for every 1 rupee I'm going to get as a return for every year. Let's say like I am buying Tata Motors share, and the Tata Motors shares is giving a EPS of, let's say, 5 rupees. Okay, let's say like that. This is the earnings per share available. And on this 5 rupees and the market price of the Tata Motors share is, let's say, like 100 rupees, then I can say for every $1 or 1 rupee that the Tata Motors is going to give me in that year, I'm ready to pay 20 rupees for the procurement, for the buying of that share. So these are all the various ratios that one must see while buying a company share. So in this video we have seen about what are all the analysis that we must do. It started with the industry analysis, company analysis, and then the financial analysis. Under financial analysis, I have detailed about what to see in the balance sheet and what to see in the profit and loss account. And using these two statements, how to compute various ratios. Like we have seen about 3 types of ratios, which are the profitability ratios, liquidity ratios, leverage ratios. So one must keep in mind while doing this uh, investment, all these things, to be a intelligent investor. And thank you for watching this big video.